Peter Rose, Longwood Currency Trading. $1,200, 8 pips, 5 minutes. Well, 10. I'm out here in the kitchen getting a fresh cup of coffee to celebrate that. And I'm not bragging about it, but everything that I've said through all of my videos has been, as you're learning to trade and building your account, you trade by the pips and not the dollars. Because when you get up into the larger dollar sizes and you start adding to your position, staging, or whatever, then it becomes a dollar function of how you're manipulating that price and the average value. And so if you haven't trained yourself to look in terms of the number of pips, the value of a pip, then you're evaluating your success based on the dollars you make, and you can't do that, because then when you lose $4,000 or $5,000, or if you're in a smaller situation, you lose $200 or $300, you just think you're an idiot, and you can't think that way. When you're evaluating your trading, you cannot evaluate it by the number of dollars that you make, because the number of dollars that you make is not an indication of your skill. Because I have a 6-figure account and I can make $100 or $200 a pip, doesn't make me any better when I make $2,000 when that might be 10 pips, and you make $40 on a $1,000 bank. Just because I have more money doesn't really mean anything. It's how did you manage the number of pips that you ultimately got out of that trade. You take a $100,000 account and make $300 by making 3 pips. So it isn't the dollar that indicates the skill. But where the real skill comes in, I think, is in saying, look, what's reasonable for me for the time I'm going to be sitting at the trading desk? Well, what's reasonable? Now, if you're in a slow, range-bound market, then your daily ATR may be, 20 pips or something. That's going to be hard to make some money. But generally, if you're trading the majors, you're going to get, even in if you're off hours, then you're looking at a 15-minute chart and you may be getting an average candle size of 4 or 5 pips throughout the closeout. But if you're trading a reasonable currency pair with a reasonable leverage, then you're going to find your sweet spot for what number of pips you can average. And this is where your metrics and your calculation of your metrics come into play. And they're so important in your evaluation of your skill. You get to the end of making a couple of hundred trades and you go back over it, and you have to, those are the metrics of win-to-loss ratio, your average win value. When you win, how much do you win? Your per trade expectation value. There are all kinds of metrics that you can calculate, and one of them is going to be, when I win, what's the average pip value that I have? Because that gives you a sense of confidence in looking at a trade. You say, oh man, this trade's offered me 60 pips. Well, yeah, but over the long term, you've had the skill to identify trades and get out of there with 10 pips. Let's just say 10 pips. So you're looking now at plotting a trade to get 60. That's not really reasonable, because if you were able to get 60 several times and then you lost 25 or 30 and then you made 10 and then you see you're all over the place. That doesn't mean that anomalies in the trading won't take place. And you have to take that into consideration in your average value. That's why you need 100 trades, because if you make one trade and you make 60 pips on one or two trades, and then the rest of your trades are all clustered around 5 pips, then you're going to be wrong in looking at an average capability of your pip value. You don't look at averages, you have to look at a median value. So you better know the difference between average and median, because your median between 5 pips 50 times and 60 pips 3 times is going to give you a 5 pip and a 60 pip is going to give you a median value of 5. There's as many below 5 that you get as there are above 5. And so you could say, well, okay, I can expect 5. So if I'm looking at it's 50 or 60, and I get 50 or 60, I don't change the expectation of the number of pips that I'm going to get. I know what my average winning pip value is, and it's not 60 pips, because I'm a day trader. What's my expectation during the course of a day? And that can be clouded too, because you can't go on a daily basis. You can't say, oh, today I made 60 pips. Yeah, well, one trade you might have made 40, and the other 6 trades you might have made 2 pips or 3 pips or whatever. So you really have to be careful about how you're doing this. You have to do it on a per transaction basis. I mean, that's really what you have to do, on a which would be per position basis, because you may be making many transactions to form a position. Yeah, and so when you're developing your skills in that 4-figure account size to low 5-figure account size, where you're doing all in, all out, that's where you get some really clean metrics to work with and to determine what your skill level is. And so that average pip value, it's not really an average, it's more of a median pip value on your winners, is a really important thing for you to know, because then you can say, no, this congestion of order flow is really too close. It's 15 pips away, but my expected win value is say 10 pips. Well, I'm within 5 pips of this congestion value. So am I really going to be able to get there, or is there going to be a buffer? So maybe that's not a good trade for me to go into, because there's a lot of order flow resistance to me being able to get to that level. That's a good thing to know. And so don't pat yourself on the back for having a large median per position trade value, because more often than not, that's not sustainable. That's why I say, you got to do it over like 200 or 300 trades to really get a good idea. The best time to get your idea of how you did is at the end of the year. I produce a big transaction report from my broker logs. I wrote a computer program that goes through there and calculates about a dozen metrics that I compare with the previous year or the previous month or whatever, and I can run that report on a monthly basis or whatever I need to do, because it just takes that broker report and creates the positions and then does the metrics based on the closed positions. But in the instance where I talk to you about the amount of money that I make, you have to bear that in mind, that I'm not making any more pips than you should be able to make. This particular trade that I just made $1,200 in 10 minutes was 8 pips, right? And the reason I did that, you'd say, well, how can you stage in, all that weight? I think it was 15 lots. And where did you stage that all in? Well, it was about a 12 pip move, I guess, when I staged all those. I had about 12 pips to stage them all in, 12 or 15 pips. Because I staged a couple of them in as price was moving against me. So I didn't have a whole lot of room to stage, and so I think, you know, I've been talking a lot in my videos about staging, and I think there's a difference, and I cover this in my Advanced Solutions course, which is not a course, it's part of a series of 4 modules in that course. But the takeaway here is that you have a difference between staging. I wasn't staging, I was adding to my position. Staging is done in a linear fashion. Your price goes to here, you add one, price goes to here, you add another one, price goes to here, you add another one, and you keep doing that all the way up until you sense weakness in the market, or the price goes against you too far and you get out, and hopefully all the little things that you've added in add up to a considerable amount of money. I've talked a lot about staging because it's when you get to an advanced level, it's the next logical thing that we would talk about as far as how to do this stuff. And the next complication to that is adding. So you have a asymmetric process of adding lots. Sometimes you add them as your price is going against you. Sometimes you add them where you added the last one. So it's it's a mix of increasing the size of your position, but not by staging, because staging is more of a linear process. But the core is that I knew I didn't have much room. I was dealing in I'll tell you what I was dealing with. Price was spiking downward, and I had 2 15 pip 5-minute bars, and I still felt that there was some room to go. I felt that there might be about 15 more pips to go before we ran into some order flow congestion at the bottom. And so I went in with 3 lots to test it. It went against me. It came back. It went 5 pips in my favor. I added another. I added another 3. It went against me. And went against me real far. I'm underwater now. I added 3 more. It comes way down. I'm in 3 more, or maybe I added 6 more. I don't know what the thing was, because I'm just going bing, 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 bang, trying to pick up as many lots as I can so that the minimal amount of pips that I'm going to get out of this trade is maximized from a dollar standpoint. But I'm not thinking about the dollars. I'm thinking about I've got to have an average position that is going to give me a safety net of a potential 12 pips, so that I can be pretty rust assured as I'm adding these lots in here that I'm going to get an average of 8 pips. And you know, and I did. I mean, as a beginner, you're not going to be able to do this. You don't have the experience to do the trade and go through all these calculations in your head. It's like driving a car. When you first learn how to drive a car and you're asked to make a left-hand turn in the United States, that's, you know, going left. It's going against traffic, oncoming traffic. All this shit's going through your head. You know, is the light? What color is the light? Are there pedestrians? Does the kid throw a ball on the thing? What's oncoming traffic like? Do I have some jackass that's blown the light on this side and he's coming on through? What's going on behind me? All this stuff's going on in your head before you try to make this light. Do I have my blinker on? My foot on the brake the right way? When you get experience driving, 6 months or a year, you're talking to your friend and listening to the radio, and you're driving along and you scan everything and you make your left-hand turn. So trading is not that difficult. If you can drive a car, you can trade. But, you know, just don't try to skip the steps. And you got to concentrate on what's important. And so you want to make big money, don't worry about making big pips. That's your problem as to where you come up with the money in order to put into your account. What I'm trying to help you do is get a solid foundation in getting 8 pips on average regularly, or 10 pips or 20 pips, or whatever your capability is of getting, and that has to do with the currency pair that you trade as well. So it's not only your experience, but it's the pair that you trade, it's the time of day that you trade. You have to learn all this stuff. If you have a correlated, chronologically advancing set of exercises that you go through in training, that's what I present in my course book, my course. It's Foundations, Principles of Trading, Process-Oriented Trading, and Advanced Solutions. And it goes through that, and it covers the 3 major questions that you have to ask about every rule that you make and about everything that you do. What do I have to do? How do I do it? And when do I do it? And all of that, we hope, within a 3-month period of time, as you're going through this development. I mean, if you have a lot of experience, if you already have a year of trading, a live account, no simulated stuff. But if you've got a year of trading, a live account, trading a couple of minis, you could get through that stuff in 2 weeks and get on to the principles stuff. Nothing is going to hold you back because the stuff is so simple. You have to read and read and read and read and read about it, and I'm very repetitive in my presentation, so that you keep getting until you finally say, Jesus, the guy said this about 15 times. I'm so sick of hearing him say this. Well, it must mean something. And so you can forget the rest of it and just learn what that principle is. That's principle-based trading. And then you take the principles and you go into process-oriented trading, where you apply the principles. The principles are an outline of what your strategic methodology is, and your advanced solutions gives you tactical measures of taking advantage of order flow. That's how it's all ordered together. It's not cheap, because what are you going to be able to make if you're good at that? I made $1,200 today in 10 minutes. You think I'm going to sell you a course for $500? I don't think so. So that's why not many people train with me, and I don't want many people to train, because my time is more valuable than charging somebody money for courses. I don't have time for that. If you're really serious, then I know you're going to really work at it, and we can become friends, and we're going to work together as co-traders. That's just the way this is the way that it is. If you can't do that, then go take somebody's $500 course. They'll teach you what a pip is and how to size your bank and all that other shit, and it's not going to help you do with the trading. But that's your decision that you have to make. What I'm trying to get across to you for free is trade by pips, and don't trade by the dollars, and have a trading plan that gives you this chronologically advancing series of rules that takes you through the full life cycle of a currency pair, which is your entry analysis, your position management, and your exit methodology. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.